All right. Just now I already explained about the lump sum need, and the second part is about the resources. Okay, so therefore now we outline the resources belong to the client. All right, so the item that we have, obviously the saving accounts, fixed deposit, current account, life insurance, cash value, and other important things is obviously the existing EPF as well as the future EPF. Okay, so as for the saving deposit, fixed deposit, current account, life insurance, cash value, all of this figure, existing EPF, you can get all of this figure from the net worth statement of the client in the fact finding sheet. Okay, and then you include the I. How much is the I based on the economics index, or the assumptions that you agreed between you and your client, and N is number of years before we reach retirement, and we calculate the FV. Okay, so same goes to this current account, or if the client have unit trust or shares or whatever, I include that. If the client has a house, let's say has a property for the purpose of retirement, only you can include, which means your client mentioned to you that I bought this property for the purpose of retirement. But if your client didn't mention about that, which means that they want to buy investment property for the child ke, for the future generation ke, means that not for retirement, so cannot include that in this column. Okay, so if your client has an investment property, in the asset they have their own residential home, but at the same time also have an investment property, you have to take note here, put a notes here in the retirement part that your client said that, or your client agreed that the investment property is not for retirement, therefore it's not being included in the asset here. Okay, so as for the existing EPF, I talk about existing EPF first. Yes, you calculate here is the dividend over 22 years, then you can get this figure. As for the future EPF, okay, so you can follow this formula. Okay, this is income plus bonus. You can get this from cash flow statement from the fact finding sheet times with 23%. All right, so 22% is the contribution by you and the employer, times with 1.05, 22 minus 1.04, 22, 0.04 minus 0.05 minus 0.04. This is the formula. This is how you can get the future EPF contribution. Okay, the future value of EPF contribution. Okay. Next, I would like to explain is about life insurance cash value. Okay, life insurance cash value. Life insurance cash value is a bit complicated, but it's okay. Take it easy. This is the figure 23,616 is from the your net worth statement. Okay, your net worth statement mentioned that your insurance cash value is this figure. You already have the calculation before, right? Like 30% out of the premium, you already have this calculation before, so that is the current value. One thing you should understand is that this cash value or insurance cash value, it will be increased. It will keep increase, you know, like from year to year. Therefore, okay, as for life insurance cash value, let's say we make an assumption, because in the project paper you can make assumption. Okay, life insurance cash value, let's say the assumption is 30% times with premium times with number of years of the policies. Okay, so you also have to highlight in the notes that it is assumed that the cash value is 30% out of the premium. So as in this case, your current cash value is 23,616. Where you can get this, you have to look back at the net worth statement that you have already calculated before, and you should understand this is the cash value now. In 22 years, in the next 22 years, it will, you know, like keep increasing. Therefore, let's say, provide this calculation, like 30%, let's say, 30% is normal. Therefore, 30% times with the premium. So as in my example is 3,000. So as in your case, you look back at your premium per year. All right, so over 22 years, okay, because we're talking about next 22 years, so we can get this figure. Therefore, the total cash value for the insurance is like this, the current cash value, plus the cash value for the next 22 years, then you can get this figure. Therefore, as in the calculation, life insurance cash value current is 23,616, and is 22 years, all right, 22 years, and then the future value is 43416. Okay, so this is how we calculate for our life insurance cash value with the assumption that the cash value is 30% out of the premium, and it is a must. You have to put this calculation, must. It is important. You have to put this calculation, how you calculate the life insurance cash value. You should, like provide a notes. You can also provide a notes for this column, provide a notes for life insurance cash value. You make another column, put a notes here, notes for life insurance cash value, as well as the notes for future annuity, or if you provide the calculation straight away like this also can. But the most important things, the assumption that you use, you have to make a notes, you have to put a notes, because the one who read it don't understand it. If you didn't put a value, didn't put an explanation. Like me, for example, if I see this, why this figure change? What is the assumption? Why? So if you provide a notes and explanation that the current value of the life insurance based on the net worth statement is 23,600, and then we make an assumption that for the next 22 years there will be 30% of the premium will be considered as the life insurance cash value, blah 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 blah, and then you provide this calculation, and this will be the final figure, and then people will easily understand that. So it is important, it is must for you to do that. All right, now you already calculate the lump sum need on the first year of retirement, and you also calculate the resources on the first year of retirement. Okay, you have to understand that there is all of these resources are based on the first year of retirement. You have the information now, but you're not going to use it now. You're going to use it on the first year of retirement. That's why you calculate here the N is 22. Okay, therefore the lump sum need you already have here. Alright, and then the resources here, and then you will have a shortfall. Make sure you have shortfall. If you don't have a shortfall, create a shortfall, because if you don't have a shortfall, okay, if you don't have a shortfall, how you're going to give a recommendation? So you have to create a shortfall. Okay, shortfall is important. All right, so you create a shortfall, but the shortfall must not be too big. Like make sure the shortfall is around 400,000, 200,000, 300,000 is acceptable. Make sure that the shortfall is not like 1 million, 2 million, 3 million. How you want to give a recommendation for your client to make a saving for like 3 million, Then she will ask them to make a saving like yearly, like 10,000. Then your client will surrender already. I myself also cukup makan lah. And then you ask me to make this very huge saving lah. Sorry lah, I'm not going to take you lah as my advisor. Cannot lah. So you have to be reasonable, and like this figure, for example, it will be acceptable, like 400,000, 300,000. You can make an adjustment, right? Okay, so based on the shortfall, then you please, right, you give a suggestion to your client to make saving. Okay, so this is the shortfall, the future value of 450,000. Now we have another 22 years. Therefore, you keep in the retirement, you keep in the PRS. Let's say the PRS, you have to check what is the rate given by the PRS, and then we can get the value. Okay, all right, so once you get the value, it's time for you to calculate what will be the yearly payment that you have to make every year. Okay. For this figure, future value is 450,932. This 854 is the present value, which means let's say your client has a lump sum now. Okay, let's say your client has a lump sum now. Let's say they suddenly get a bonus for 138,884. Then you can use this lump sum lah to keep in the PRS or keep in unit trust or whatever, so that they can get this future value. Or for example, if they are not lucky enough to get the lump sum, nobody want to give 138,000 just for free, right? So they have to make a yearly payment lah, make a saving, put it in the PRS. Of course, you have to give suggestion to keep in the PRS, because you want to ask them to get a tax relief, okay, for the tax planning. Alright, so don't worry, they have to make a saving for the next 22 years, still have plenty of time for them to get the future value of 450,932. Alright, that's all for retirement planning as usual. Provide notes, make it better, make it more organized than the previous students. That's all for my explanation. Thank you. Assalamualaikum and bye-bye.